Anything that is separate property is treated differently than community property when it comes to taxes.
Taxes. Right.
So your primary residence, we all get a capital gains exemption for living in your home. So if you get a $250,000 per spouse exemption. So if you're not married, you only get or you're not, if you're not married. If you're not married, you only get the $250,000. If you're married and you're both on title and it's your community property, you get $500,000. Right. So if your other spouse doesn't own the property because you've kept it separate, then you only get the $250,000 exemption. Just because you're married doesn't mean you get that exemption automatically.
Mm-hmm. Yeah, only the owners get it. The other sort of important point from our client's perspective is that the treatment of the capital gain on death. So the person who owns separate property, when they die, their separate property gets a new stepped up tax basis. Stepped up tax basis is good. That's always good. We always want that. So you get that on everything that you own when you die. But if it's your spouse who owns the separate property and they die, that's great. But if you die and it's not your separate property, it's your spouse's separate property, it's not going to get a stepped up basis.